Right now, the average American family is sitting on a tax time bomb set to explode in 2026. When that happens, everything above $7 million in your estate could be taxed at up to 40%, potentially erasing millions from your family's legacy. But there's a solution, and it doesn't require being ultra-wealthy to implement. Today I'm showing you 3 powerful strategies that can protect your hard-earned assets from this looming tax disaster. And the best part? You still have time to act if you start now. The 2026 tax time bomb. Why your family's wealth is at risk. What if I told you the government has already scheduled a date to potentially take millions from your family's wealth? It's not a conspiracy theory. It's written into our tax code. Right now, we're living in what financial experts call a golden era for wealth transfer. The current estate tax exemption sits at a generous $13.99 million per individual. That's a whopping $27.98 million for married couples. But here's the kicker. This generosity has an expiration date. When the clock strikes midnight on December 31st, 2025, these exemptions are set to drop dramatically, roughly in half. We're talking about a reduction to approximately $7 million per person. That's not a typo. Millions of dollars in tax protection will vanish overnight. Let's break down what this actually means for your family's wealth. The estate tax isn't just any tax. It's a hefty 40% rate that applies to every dollar above the exemption threshold. Do the math, and it gets scary fast. If you're an individual with a $14 million estate, under current law, you'd owe almost nothing in estate taxes. But after 2026, you could suddenly owe $2.8 million in taxes. For married couples with estates valued at $28 million, the tax bill jumps from practically zero to a staggering $5.6 million. That's money that could have funded your grandchildren's education, launched the next generation of family businesses, or supported your favorite charities. Instead, it goes straight to the IRS. Now, you might be thinking, this doesn't affect me. I'm not ultra-wealthy. But here's why you should still pay attention. These exemption limits aren't as far away as you might think. A successful small business owner who spent decades building their company could easily have a business valued at several million. Add in your home, especially if you live in areas like California or New York, your investment portfolio, retirement accounts, and life insurance policies, and suddenly you're much closer to that threshold than you realized. The truth is, many middle-class families are quietly building estates that will eventually bump up against these limits. Think about it. A couple who diligently invested in their 401k, purchased real estate at the right time, and built a modest business could easily accumulate assets worth $7 to $10 million over their lifetime. And that's before considering future growth and inflation. Speaking of inflation, it's perhaps the most silent threat to your estate planning. Even with moderate inflation of 3% annually, the real value of that $7 million exemption in 2026 will continue to shrink each year afterward. Assets that seem safely under the threshold today could easily exceed it with time, especially considering how wealth compounds. Take the Johnson family as an example. Tom and Sarah started a small manufacturing business in the Midwest in the 1990s. They never considered themselves wealthy, just hardworking small business owners. Their company grew steadily, and they invested in commercial real estate to house their operations rather than renting. Fast forward 30 years, and their business is now valued at $6 million, their commercial property at $3 million, their home at $1 million, and they've accumulated $2 million in retirement savings. That's a $12 million estate they built from scratch, and in 2026, they could face a potential estate tax bill of $2 million without proper planning. Or consider the Martinez couple from Arizona. They purchased several rental properties in Phoenix back when prices were low. Over 25 years, those properties appreciated significantly while providing rental income. Combined with their other assets, their estate now approaches $9 million. They never thought of themselves as part of the wealthy elite. They drive modest cars and live in the same home they bought 30 years ago. Yet without planning, their children could lose over $800,000 to estate taxes after 2026. The most frustrating part? These tax bills are completely avoidable with proper planning. But that planning needs to happen now, not in late 2025 when everyone else is scrambling. Think of the 2026 deadline as a closing window of opportunity. Right now, you have the chance to transfer significant wealth, up to the current exemption amounts, completely tax-free. But once that window closes, those opportunities disappear. The good news is that there are proven strategies that can protect your family's wealth from this looming tax bomb. Throughout this video, we'll explore 3 powerful approaches that families of all wealth levels are using to shield their assets from unnecessary taxation. First, we'll look at specialized trust structures that allow you to remove assets from your taxable estate while still maintaining family access and control. These aren't just for the ultra-wealthy. They can be set up with assets worth as little as $500,000 and still provide significant tax benefits. Second, we'll explore strategic gifting methods that leverage the current high exemptions without disrupting your financial security. These techniques allow you to lock in today's higher exemption amounts before they disappear. Third, we'll discuss how to structure family governance systems that not only minimize taxes, but ensure your wealth actually strengthens future generations rather than weakening them. Because preserving family values is just as important as preserving family assets. The stakes couldn't be higher. The 2026 tax changes will cut your exemption in half, potentially costing your family millions. But only if you fail to act before the deadline. The SLAT strategy: how to gift assets while still using them. With the 2026 deadline looming, one particular strategy stands out for families who want tax protection without financial sacrifice. Ever heard of a trust that lets you give away your money for tax purposes, but still lets your household use it? It sounds too good to be true, but it's exactly what a spousal lifetime access trust delivers, and it might be perfect for your situation. Here's the problem most families face when considering estate planning. You either keep your assets and face massive taxation later, or you give them away now and lose access to them completely. Talk about being stuck between a rock and a hard place. This difficult choice stops many families from taking action, even when they know the tax consequences are coming. This is where the Spousal Lifetime Access Trust, SLAT, comes in as a game changer. A SLAT is an irrevocable trust with a genius twist. One spouse creates it for the benefit of the other spouse. It's like having your cake and eating it too. Let me explain how this works. Let's say John wants to protect some family assets from future estate taxes. He creates a SLAT and names his wife Sarah as the beneficiary. John transfers assets into the trust, maybe stocks, real estate, or business interests, removing them from his taxable estate and using his current higher exemption amount. Here's the magic part. While those assets are now officially gifted away for tax purposes, Sarah can still access and use them as the beneficiary. The family hasn't lost the ability to benefit from these assets at all. But wait, what exactly can Sarah do with these trust assets? The trust can be structured so she can receive distributions for her health, education, maintenance, and support. That's lawyer speak for a pretty broad range of normal living expenses. Need money for medical bills? Covered. Want to go back to school? No problem. Need funds to maintain your standard of living? That's typically allowed too. The tax benefits are significant. First, you're locking in today's higher exemption amounts before they drop in 2026. Second, all future growth on those assets happens outside of your taxable estate. Think about that. If you put $5 million into a SLAT today, and it grows to $10 million over time, that entire $5 million of growth escapes the 40% estate tax. That's potentially $2 million in tax savings just from the growth. Now, what kinds of assets work best in SLATs? The ideal candidates are appreciating assets, things you expect to increase in value over time. Stocks and other investments with growth potential are perfect. Business interests, especially if the business is expected to expand, can be excellent candidates. Real estate that's likely to appreciate works wonderfully too. The key is to transfer assets before they grow in value, maximizing what you can shield from future taxation. Let me share a quick example. Imagine you own a small business currently valued at $3 million, but it's growing quickly. By putting it in a SLAT now, you not only use your current exemption on the $3 million value, but if the business grows to $8 million in the next decade, that additional $5 million of growth happens completely outside your estate. Without the SLAT, that growth could face a 40% tax bill, costing your family $2 million. Now, SLATs aren't without potential pitfalls. Let's talk about 2 big ones you need to be aware of. First, there's the divorce risk. If you create a SLAT for your spouse and later get divorced, you've created an irrevocable trust that benefits someone who's no longer your spouse. Awkward. That's why careful planning with your attorney is essential to address this possibility in advance. Second, there's what tax pros call the reciprocal trust doctrine. Some couples think, hey, I'll create a SLAT for you, and you create one for me, and we'll both be protected. Not so fast. The IRS isn't stupid. If both spouses create nearly identical SLATs for each other, the IRS may uncross them and treat them as if each spouse created a trust for themselves, which provides no tax benefit at all. If you're considering dual SLATs, they need to be sufficiently different in their terms, timing, and assets. Beyond these specific risks, there's also the fact that SLATs are irrevocable. Once you create one, you generally can't change your mind and take the assets back. That's why proper planning and consideration of all possible future scenarios is absolutely essential. But despite these cautions, SLATs have become increasingly popular as families prepare for the 2026 exemption reduction. They provide a strategic avenue for families to transfer wealth while maintaining some level of control over the assets. The grantor can dictate the terms of the trust, including how distributions are made and who will eventually receive the assets after both spouses are gone. The beauty of a SLAT is the balance it strikes between tax protection and financial security. You're removing assets from your taxable estate, but your household still has meaningful access to them through your spouse. It's especially valuable for younger couples who are building wealth but aren't ready to completely give up access to their assets. I've seen families successfully implement SLATs to transfer significant assets while minimizing estate tax exposure. One couple in their 50s transferred a $4 million investment portfolio into a SLAT. They locked in today's higher exemption amount, and the wife still has access to those funds if needed. Meanwhile, the investments continue growing outside the husband's taxable estate, potentially saving hundreds of thousands in future estate taxes. SLATs are becoming popular because they let you gift assets while your spouse still has access to them. The perfect balance of tax protection and financial security. They represent one of the most practical ways to prepare for the 2026 changes without sacrificing your current financial flexibility. Family limited partnerships, the secret wealth preservation tool. If you think SLATs sound impressive, wait until you discover what billionaire families are using to transfer massive wealth at a serious discount. The Family Limited Partnership, or FLP, is a wealth preservation powerhouse that most Americans have never heard of, yet it's managing billions in family assets across the country. While your neighbors might simply write a check to their kids or add them to a property deed, wealthy families approach asset transfers with strategic precision. And that precision often comes in the form of a family limited partnership. Here's what makes FLPs so powerful. They allow families to pool their resources together while maintaining strict control over how those assets are managed. Think of it as creating your own family investment company. The parents typically serve as the general partners, the ones making all the important decisions, while the children or other family members become limited partners who own a portion of the assets, but have minimal say in how they're managed. This structure solves one of the biggest concerns wealthy families face. How do I transfer significant assets to my children without giving them complete control before they're ready? With an FLP, you can begin the transfer process while still maintaining the decision-making authority, perfect for preserving family wealth across generations. But the real magic of family limited partnerships happens when it comes to tax advantages. Here's where things get interesting. When you transfer limited partnership interests to your children, the IRS actually allows you to discount the value of those interests by 30 to 35% compared to their fair market value. Yes, you read that correctly. You can legally give your children a $1 million business interest, but tell the IRS it's only worth $650,000 for gift tax purposes. This discount is perfectly legitimate because limited partners can't control the partnership, can't easily sell their interests, and can't force distributions. These restrictions genuinely reduce the market value of what you're giving. Let me show you how powerful this can be with a simple example. Imagine you own a business worth $3 million. If you were to gift it directly to your children, you'd use up $3 million of your lifetime gift tax exemption. But if you first place that business in an FLP and then gift limited partnership interests to your children, Those same interests might be valued at just $2 million for tax purposes because of the applicable discounts. That's $1 million less of your lifetime exemption used up, allowing you to transfer substantially more wealth before hitting tax thresholds. Beyond the tax benefits, FLPs create remarkable protection against life's uncertainties. Let's say one of your children goes through a messy divorce. Unlike directly owned assets that could be split with an ex-spouse, a properly structured FLP can provide significant protection in divorce proceedings. The partnership agreement can mandate that the interest be bought back by the family at fair market value rather than being transferred to an ex-spouse. Same thing with creditor protection. If a family member faces a lawsuit or significant debt, creditors typically can't force their way into the partnership or seize its assets. Instead, they're limited to what's called a charging order. Basically the right to receive distributions if and when they're made, which the general partners control. Some creditors will settle for pennies on the dollar rather than wait indefinitely for distributions that might never come. Another powerful benefit is the opportunity to train the next generation in wealth management. By giving your children increasing partnership interests over time, you can gradually involve them in the business of managing family assets while still maintaining control. It's like having a family wealth apprenticeship program built right into your estate plan. For instance, one family I learned about used their FLP to hold their commercial real estate portfolio. The parents served as general partners, making all the important decisions about property acquisitions, management, and sales. Meanwhile, over a period of 15 years, they transferred limited partnership interests to their 3 children. The kids attended quarterly meetings where they learned about property management, financing, and investment strategies, all while the parents maintained decision-making authority and controlled the timing of any distributions. Now, FLPs aren't for everyone. There are some common misconceptions worth addressing. First, while you don't need to be a billionaire to benefit from an FLP, there is a practical minimum threshold where they start to make financial sense. Generally, you should have at least $1 million in assets to place in the partnership for the benefits to outweigh the costs, particularly if you have significant real estate holdings or a closely held business. Speaking of costs, setting up and maintaining an FLP isn't cheap. You'll face legal fees for drafting the partnership agreement, potentially separate accounting costs, and ongoing administrative requirements. These structures require proper maintenance. You can't just set them up and forget about them. Also, FLPs work best with certain types of assets. They're ideal for holding family businesses, real estate investments, and securities portfolios. They're less suitable for personal residences or assets you need regular access to for personal expenses. The IRS also scrutinizes FLPs carefully, so you need to run them like legitimate businesses. That means separate bank accounts, regular meetings, proper documentation, and reasonable compensation to the general partners. Cutting corners here can invalidate all those valuable tax benefits. Perhaps the most important thing to understand about FLPs is that they're part of a comprehensive wealth strategy, not a quick tax fix. The families who benefit most from them are thinking decades ahead. Annual gift tax exclusion, the simple strategy anyone can use. After exploring the complex world of family-limited partnerships, let's switch gears to a wealth transfer strategy so straightforward that almost anyone can use it starting tomorrow. While wealthy families might leverage sophisticated legal structures, the IRS has actually built a simple wealth transfer method directly into the tax code, and most Americans completely ignore it year after year. What if I told you the IRS lets you give away $19,000 per year to as many people as you want completely tax-free? This isn't some complex loophole requiring expensive attorneys. It's literally written into the tax code as an invitation to transfer wealth without touching your lifetime exemption. The annual gift tax exclusion is perhaps the most underutilized wealth transfer tool available to Americans. In 2025, each person can give up to $19,000 to any individual without triggering any gift tax consequences whatsoever. The beauty of this strategy lies in its simplicity. There are no complicated trust documents to draft, no ongoing maintenance fees, and no minimum asset requirements to meet. Yet most people completely miss this opportunity each year. Think about it. That's $19,000 of tax-free wealth transfer per recipient that simply disappears if you don't use it. Unlike your cell phone data plan, these exclusions don't roll over. Every January 1st, You get a fresh $19,000 exclusion for each person you might want to benefit, and every December 31st, any unused portion vanishes forever. For married couples, the opportunity becomes even more powerful through a concept called gift splitting. When spouses agree to split gifts, they can effectively double the annual exclusion to $38,000 per recipient. The math here gets impressive quickly. Let's say you're a married couple with 3 children and 5 grandchildren. In 2025 alone, you could transfer $304,000 to your descendants completely tax-free, without using a single dollar of your lifetime exemption. The compound effect over time is where this strategy really shines. If that same couple gifted $38,000 annually to just their 3 children for 10 years straight, they'd transfer over $1.14 million completely tax-free. That's a substantial amount of wealth moved out of their taxable estate without complex legal structures or expensive professional fees. But the real power comes when these gifts are invested wisely. Imagine your child or grandchild investing that $38,000 annual gift in a diversified portfolio. Over decades, the growth could be extraordinary, potentially multiplying several times over. By starting this process early, you're not just transferring wealth, you're transferring the opportunity for that wealth to grow outside of your taxable estate. Now let's talk strategy. While cash is the simplest asset to gift, it's often not the most tax efficient. Consider gifting appreciating assets instead. Stocks, mutual fund shares, or fractional interests in real estate that you expect to increase in value make excellent gifts. Why? Because not only do you remove the current value from your estate, but you also remove all future appreciation. For example, gifting $19,000 worth of stock that doubles in value over the next few years means you've effectively transferred $38,000 of wealth while only using your $19,000 annual exclusion. That future growth happens completely outside your taxable estate. The types of property you can gift are incredibly versatile. You're not limited to cash or publicly traded securities. Gifts can include closely held business interests, real estate, artworks, collectibles, or virtually any other type of property, as long as the total market value stays under that $19,000 per person threshold in a calendar year. Timing also matters. For assets that might fluctuate in value, consider gifting when valuations are temporarily lower. This allows you to transfer more shares or a larger percentage of ownership while staying under the annual limit. Let's address some common misconceptions about gift taxes. First, the person receiving the gift never pays tax on it. This is exclusively the donor's responsibility. Second, gifts to your spouse, if they're a U.S. citizen, are completely unlimited and never count toward any gift tax exclusion. Third, direct payments for someone's education or medical expenses are completely exempt from gift tax limits when paid directly to the institution. But we'll dive deeper into that incredible opportunity in the next section. What about documentation? If your gifts stay within the annual exclusion amount, no gift tax return is typically required. However, if a gift exceeds the annual exclusion limit, you'll need to report it to the IRS using Form 709, Gift Tax Return, the following year. Don't panic though. This doesn't necessarily mean you'll owe any tax. It simply means the excess amount counts against your lifetime exemption. For married couples using gift splitting, you'll both need to file Form 709, even if only one spouse actually owned the gifted property. This signifies that both spouses have agreed to split gifts for that calendar year. One important note, consistency matters with this strategy. Making annual exclusion gifts shouldn't be a one-time event when you suddenly realize you might have an estate tax problem. The most successful families incorporate this into their regular financial planning rhythm, making strategic gifts each year as part of their overall wealth transfer plan. Let me share a quick example of how one family put this into practice. The Johnsons, a couple in their 60s, realized they had built a substantial estate through their successful small business and real estate investments. Rather than waiting until they were in their 80s to address potential estate taxes, they began a systematic gifting program when their grandchildren were born. Each year, they gifted the maximum amount to each of their children and grandchildren. Over 15 years, they transferred nearly $3 million tax-free, significantly reducing their eventual estate tax exposure while helping their children buy homes and fund their grandchildren's 529 college savings plans. The unlimited education and medical exclusion. the hidden tax loophole. While annual gifts are certainly an effective strategy, there's something even more powerful hiding in the tax code. The IRS has created what might be the ultimate wealth transfer loophole, allowing you to pay unlimited amounts for specific expenses without any gift tax impact whatsoever. That's right, unlimited. No annual limits, no lifetime exemption usage, completely tax-free transfers that can potentially move millions across generations. This incredible opportunity is known as the unlimited education and medical exclusion. Unlike the annual gift tax exclusion that caps you at $19,000 per recipient, this provision has absolutely no dollar limit. You could pay $250,000 for your grandchild's college education or cover a $100,000 medical procedure for your child, and the IRS won't count a single penny toward your gift tax limits. What makes this so remarkable is the stark contrast between how the IRS normally treats gifts versus these special categories. For standard gifts, they track every dollar above the annual exclusion and subtract it from your lifetime exemption. But for qualified education and medical expenses, they simply pretend those transfers never happened, as if you never gave anything at all. The catch: you have to follow one critical rule that most people completely miss. Payments must be made directly to the educational institution or medical provider. This is non-negotiable. If you give the money to your loved one first, who then pays the bill, you've just made a regular gift subject to all the normal gift tax rules. That single misstep can transform what would have been an unlimited tax-free transfer into one that chips away at your precious lifetime exemption. Let's be crystal clear about what qualifies for the education exclusion. The IRS specifically allows direct payments for tuition at qualifying educational institutions, from preschools to universities and even trade schools. However, they're quite strict about what counts as tuition. The exclusion only covers instruction costs, not books, supplies, room and board, or activity fees. Those expenses would need to be covered through other means, like the annual exclusion gifts we discussed earlier. On the medical side, the rules are similarly specific, but quite generous. Qualified medical expenses include payments made directly to providers for the diagnosis, cure, mitigation, treatment, or prevention of disease. This covers doctor visits, hospital stays, surgeries, and even health insurance premiums. Think about that for a moment. You could pay the health insurance premiums for your entire family, year after year, without any gift tax implications. The wealth-building potential here is enormous. Consider a set of grandparents who want to help their 4 grandchildren attend college. With today's education costs, they could easily spend $250,000 per grandchild on tuition alone. That's $1 million transferred completely tax-free, without touching a penny of their annual exclusion gifts or lifetime exemption. If those same grandparents had tried to make regular gifts of that magnitude, they would have used up a significant portion of their lifetime exemption. This strategy becomes even more powerful when coordinated with other planning techniques. Imagine combining the unlimited medical and education exclusion with strategic annual gifting. The grandparents in our example could pay tuition directly to the university while also giving each grandchild $19,000 annually to cover books, housing, and living expenses. That's a comprehensive education funding strategy that maximizes tax efficiency. For families with significant medical expenses, the benefits can be life-changing. Consider a situation where a family member needs specialized treatment costing $100,000 that isn't fully covered by insurance. Rather than having that person deplete their savings, a wealthier family member could cover the entire cost directly, preserving both parties' financial security without any gift tax impact. But people make mistakes with this exclusion all the time. One common error is reimbursing someone after they've already paid their medical or tuition bill. Unfortunately, reimbursements don't qualify. The payment must come directly from you to the provider. Another mistake is paying for expenses that don't strictly qualify as tuition or medical care under IRS definitions. That fancy laptop for school? The meal plan? The dormitory fees? None of those qualify for the unlimited exclusion. Documentation is another critical area where families slip up. You'll want to keep meticulous records of these payments, including receipts from the educational institution or medical provider, clearly showing what the payment covered. In case of an IRS audit, you'll need to prove both that the payment went directly to the qualifying organization and that it was used exclusively for qualified expenses. Timing matters too. Some families make the mistake of waiting until year-end to make these payments, only to discover they've missed enrollment deadlines or payment windows. Since these payments can be made at any time without gift tax consequences, there's no reason to delay them for tax planning purposes. Make them when they're due, and keep your records organized. For families with substantial wealth, this strategy can be implemented systematically across multiple generations. Imagine great-grandparents paying for their great-grandchildren's education, effectively skipping 2 generations of gift taxes. That's a wealth transfer that would normally face steep generation-skipping transfer taxes, but when structured as direct tuition payments, it passes completely tax-free. There's also a psychological benefit worth mentioning. Many wealthy individuals worry about giving too much money directly to younger family members for fear it might dampen their ambition or create unhealthy dependencies. The education and medical exclusion offers a perfect solution. You can provide substantial financial support specifically for purposes that enhance their well-being and future prospects, without handing over large sums of cash. Think about how this fits into your overall estate plan. By covering these major expenses directly, you're freeing up your loved one's other resources to invest and grow. Meanwhile, you're reducing your taxable estate without sacrificing any of your annual or lifetime gift allowances. It's a win-win strategy that supports your family while optimizing your tax position. Dynasty trusts, creating wealth that lasts for centuries. Let's talk about financial legacies that can outlive us all. Most families think about wealth in terms of decades. The ultra-wealthy think in terms of centuries, and they use a powerful tool called a dynasty trust to make it happen. Ever wonder how some family fortunes seem to endure through history while others vanish within a generation or two? The difference often comes down to strategic planning. Specifically, the implementation of dynasty trusts designed to benefit multiple generations while minimizing taxes. The statistics are sobering. 70% of wealthy families lose their fortune by the second generation and 90% by the third. That's right, 9 out of 10 wealthy families watch their hard-earned assets disappear within just 3 generations. But what about that remaining 10%? What are they doing differently? They're creating structures that transcend human lifespans. In places like Florida and Wyoming, dynasty trusts can legally last for up to 1,000 years, essentially creating a millennium of protected family wealth. Even in states with more modest timeframes, like Illinois, trusts can endure for 360 years. We're talking about wealth preservation on a timeline that would impress medieval royal families. Here's how dynasty trusts work. You place assets in an irrevocable trust that can last for multiple generations. Unlike regular trusts that might terminate when your children or grandchildren reach a certain age, dynasty trusts continue operating long after you, and possibly your grandchildren's grandchildren, are gone. What makes dynasty trusts particularly powerful is their tax efficiency. Assets transferred to the trust are subject to gift tax only once, at the time of the initial transfer. After that, those assets can grow for generations without triggering additional transfer taxes. Think about it. One tax event, followed by centuries of tax-free growth. This is where the generation-skipping transfer, GST, tax comes into play. Normally, the IRS wants to tax wealth each time it passes to a new generation. But with a properly structured dynasty trust, you can allocate your GST exemption to shield those assets from additional taxation as they benefit generation after generation. The timing couldn't be better. The current GST exemption is at a historic high alongside the estate tax exemption, but only until 2026. This creates a unique window of opportunity to lock in these higher exemption amounts by funding a dynasty trust now, before the limits potentially drop by half. But what assets should you consider placing in a dynasty trust? Life insurance policies are a popular choice. Imagine a $5 million life insurance policy held in a dynasty trust. When you pass away, the $5 million death benefit passes to the trust completely income tax-free, creating an immediate pool of capital for future generations. Appreciating investments work exceptionally well too. Picture placing $1 million worth of stock in high-growth companies into your dynasty trust. Over 50 years, with an average annual return of 8%, that $1 million could grow to over $46 million. all outside your taxable estate and protected from transfer taxes at each generation. Family businesses represent another ideal asset. By placing business interests in a dynasty trust, you're not just avoiding taxes, you're creating a structure that can maintain family control for generations. This can be critical for preserving the legacy of entrepreneurs who want their companies to remain family-owned indefinitely. The benefits of dynasty trusts extend far beyond tax savings. They provide exceptional protection against creditors. When your descendants face financial troubles, lawsuit threats, or even bankruptcy, assets held in a properly structured dynasty trust remain secure and untouchable. Divorce protection is another significant advantage. In an era when roughly half of marriages end in divorce, dynasty trusts can shield family wealth from being divided in matrimonial settlements. Your great-grandchildren may not make the best marriage choices, but a dynasty trust ensures family assets won't walk out the door with ex-spouses. Perhaps most importantly, dynasty trusts protect future generations from themselves. Let's face it, not everyone is born with financial wisdom. The trust can include provisions that prevent beneficiaries from squandering their inheritance or making poor financial decisions. Distribution terms can be structured to incentivize education, entrepreneurship, or charitable giving while discouraging wasteful spending. Think of the trust as a financial guardian that enforces your values long after you're gone. You can specify that distributions be made for education, starting businesses, buying homes, or healthcare needs, essentially guiding your family's financial decisions from beyond the grave. One particularly effective strategy involves combining a dynasty trust with annual gifting. You might fund the trust initially with appreciating assets, then continue making annual gifts to the trust up to the exclusion amount each year. This allows you to gradually transfer significant wealth while maintaining current tax benefits. The geographic location of your dynasty trust matters tremendously. States like Delaware, Nevada, South Dakota, and Alaska have become popular destinations for these trusts due to their favorable laws. Some states have abolished or extended the rule against perpetuities, which traditionally limited how long a trust could last. It's worth noting that dynasty trusts aren't only for billionaires. Families with estates worth a few $1,000,000 can benefit significantly, especially those with businesses or assets likely to appreciate substantially over time. The key is starting with assets that have tremendous growth potential. Of course, creating a dynasty trust requires careful consideration and professional guidance. You'll need an experienced estate planning attorney who specializes in multi-generational planning. The trust document must be precisely drafted to achieve your goals while navigating complex tax laws. When designed correctly, these trusts create a remarkable financial legacy. Imagine your great-great-great-grandchildren receiving education funding, startup capital for businesses, or healthcare support because of decisions you make today. That's the true power of a dynasty trust, extending your financial impact across centuries instead of mere decades. The most fascinating aspect of dynasty trusts is how they align with human nature. We all want to protect and provide for our loved ones. Dynasty trusts simply extend that natural desire beyond our immediate family to generations we'll never meet, but who will carry our legacy forward. It's really possible to create wealth that lasts for centuries instead of decades by using dynasty trusts to shield assets from taxes and protect them from risks across multiple generations. While most family fortunes disappear within 3 generations, yours can become part of the exceptional 10% that endures. Through careful planning and foresight. Family financial education, the missing piece in wealth preservation. You've built an incredible legal fortress for your wealth with trusts, partnerships, and strategic gifting. But here's the shocking truth. Even the most bulletproof legal structure can't protect your family's fortune if the next generation doesn't know how to handle it. Studies show that financial education is the critical ingredient that separates the 10% of families who maintain generational wealth from the 90% who watch it disappear. Think about it. What good is a perfectly structured dynasty trust if your grandchildren have no idea how to manage the assets inside it? Or worse, if they develop spending habits that drain resources faster than they can grow? The data is eye-opening. According to research from Champlain College, financial literacy education has profound, lasting impacts on students' financial behaviors, with benefits that can be measured more than a decade after graduation. Yet right now, Only 7 states in America require personal finance instruction as a graduation requirement. This massive education gap explains why so many inheritances evaporate within a generation or two. Remember that old saying, shirt sleeves to shirt sleeves in 3 generations. It means the first generation builds wealth, the second generation maintains it, and the third generation loses it all. But this cycle isn't inevitable. It's preventable when you prioritize financial education. Let's break down why family fortunes typically disappear, and none of these reasons has anything to do with market crashes or tax changes. First, heirs often lack basic financial literacy. They don't understand concepts like compound interest, inflation, diversification, or sustainable withdrawal rates. Second, poor communication creates mistrust and conflict around money. And third, without a shared family purpose or mission for the wealth, younger generations view money as something to consume rather than preserve. The millennial generation is particularly vulnerable. Research shows they struggle with fundamental financial concepts, which leads to poor decisions about debt, investments, and long-term planning. Think about that. These are the very people who will inherit trillions of dollars in the coming decades. Yet many can't explain how compound interest works or why diversification matters. So how do you break this cycle? By creating a deliberate family financial education program. Families who implement regular education initiatives, like annual retreats with financial education components, have demonstrably better outcomes in maintaining wealth across generations. Start by building a framework that addresses 3 key areas: knowledge, skills, and values. The knowledge component covers financial concepts and terminology. The skills portion focuses on practical abilities like budgeting, investing, and analyzing financial statements. The values section, which many families completely overlook, explores your family's philosophy about money, wealth, and purpose. Financial education should begin early. Even young children can grasp basic concepts about saving and delayed gratification. As family members mature, the curriculum should evolve to match their readiness and responsibilities. Remember, this isn't about forcing everyone to become investment experts. It's about ensuring they have the foundation to make sound decisions or know when to seek professional help. Let me share what a successful family financial education program might look like. First, schedule regular family meetings, maybe quarterly, where you discuss both family and financial matters. These aren't lectures. They're interactive sessions where questions are encouraged and real-world scenarios are discussed. For younger children, use age-appropriate activities like savings games or allowing them to invest a small amount with your guidance. Teenagers can participate in discussions about the family's charitable giving or even manage a portion of the family investment portfolio under supervision. Young adults might join meetings with your financial advisors or attend workshops on specific topics like real estate or business management. Consider creating a family financial literacy library with books and resources for different ages and experience levels. There are excellent board games, online courses, and even apps specifically designed to teach financial concepts in engaging ways. Some families establish a mentoring system where financially savvy family members guide others. Others bring in outside professionals for workshops on specific topics. The key is consistency and engagement, not dry lectures that everyone dreads. What makes this approach so powerful is that it combines technical knowledge with your family's unique values and history. When discussing investment principles, share stories about how your family built its wealth. When teaching about charitable giving, connect it to causes your family has historically supported. This builds both competence and a sense of stewardship. For example, one family I worked with created a mini board of directors where the teenage grandchildren could propose and vote on the family's charitable donations each year. They researched organizations, presented their findings, and collectively decided how to allocate a portion of the family's giving budget. This hands-on experience taught them about due diligence, financial analysis, and responsible stewardship, all within the context of the family's values. Another family established what they called Financial Boot Camp, a week-long summer program for family members turning 16. It covered everything from banking basics to stock market fundamentals, with guest speakers and hands-on activities. By the end, each participant opened their first investment account with a small family contribution to get them started. The research backs up these approaches. Champlain College's study found that financial education has an overwhelmingly positive impact on students' future financial habits. Those who received financial education in high school save at higher rates as adults. It's not just about preserving wealth. It's about creating financially capable individuals who can thrive in any circumstance. Now, some practical advice. Document your financial philosophy and wisdom. Create a family financial values statement that articulates your approach to money, risk, philanthropy, and wealth stewardship. This becomes both a teaching tool and a touchstone for future generations. Also, be transparent about your estate plan, at least the big picture. Many families create unnecessary drama and confusion by keeping everything secret until after death. You don't need to disclose exact dollar amounts, but explaining the general structure and reasoning behind your plan prepares your heirs and reduces the chance of conflict. Consider organizing family retreats that include educational components on financial matters. Research shows these structured gatherings are highly effective at transmitting both knowledge and values. They can combine fun activities with learning sessions to keep everyone engaged. Remember, this isn't a one-and-done conversation. Financial education is an ongoing process that evolves as family members grow and as your assets change. The investment of time may seem substantial, but compared to the potential loss of family wealth, it's minimal. One critical point: financial education isn't just about teaching heirs how to preserve wealth. It's about helping them build their own. The most resilient family fortunes are those where each generation contributes rather than just inherits. Starting small. How to begin with just $50,000. The mindset of financial education goes beyond just knowing how to manage money. It's about building something that outlasts you. And here's the game-changing truth that most financial advisors won't tell you. You don't need a massive fortune to start creating generational wealth. Just $50,000, strategically invested and protected, can create the foundation for wealth that grows for centuries. Let's shatter the biggest myth right now. Wealth transfer strategies are not just for the ultra-wealthy. While many Americans believe you need millions to even consider building a legacy, the reality is that modest sums can grow into significant wealth with the right approach and enough time. Think about the fundamental difference between those who build lasting wealth and those who don't. It's not about income, it's about mindset. Consumers spend every dollar they earn, and often more, while wealth builders think beyond their own lifetime. They're playing a different game entirely, making decisions today that benefit grandchildren they may never meet. Let me show you the astonishing power of compound interest with a simple example. That $50,000 investment, growing at a modest 8% annual return, becomes over $1 million in just 40 years. Extend that timeline to 70 years, think grandchildren, and you're looking at over $8 million. This isn't magic, it's mathematics working in your favor. For families starting with modest sums, several targeted strategies can amplify your impact. Index funds and exchange-traded funds, ETFs, offer instant diversification with lower fees than actively managed investments, making them perfect vehicles for growing modest starting amounts. These accessible investment options allow you to benefit from broad market growth without needing specialized knowledge or large minimum investments. Consider how strategic annual gifting can combine with these growth investments. By giving children or grandchildren smaller amounts annually that go directly into growth investments, you're not just transferring wealth, you're teaching the habits that create it. A $5,000 annual gift invested for a newborn could fund their entire college education by age 18 without touching your lifetime exemption. The 529 education plan deserves special attention here. This powerful tool allows families to contribute up to $95,000 in a single year without triggering gift taxes by treating it as if spread over 5 years. This front-loading strategy dramatically enhances your educational legacy by giving those funds maximum time to grow tax-free. When your grandchild eventually attends college, they'll have a significant advantage without the burden of student loans that plague so many young adults today. Life insurance is another wealth multiplication tool that's particularly effective for families with limited assets. By placing a policy in an irrevocable life insurance trust, ILIT, you ensure that the death benefit isn't included in your taxable estate. A 45-year-old in good health might pay $4,000 annually for a $1 million policy, resulting in a 25x return on premiums paid when the benefit is eventually distributed to heirs, completely free of income tax. Let me share a real-world example of how this works. The Rodriguez family started with just $40,000 from an inheritance. Instead of upgrading their lifestyle, they placed the money in a diversified portfolio of index funds focused on long-term growth. They added small contributions when possible and taught their children to do the same. 3 decades later, that initial investment had grown to nearly $600,000, which they then used to help their children purchase their first investment properties. Today, the extended Rodriguez family manages a real estate portfolio worth millions, all starting from that modest initial sum. Or consider the Chun family, who invested $50,000 in a small e-commerce business. They involved their teenage children in the operations, teaching them entrepreneurial skills alongside financial literacy. When the parents eventually retired, their children took over and expanded the business significantly. The family now operates a multi-million-dollar enterprise that supports multiple branches of the family, all from an initial investment that was less than many people spend on a luxury car. These success stories highlight an important truth. The amount you start with matters far less than the principles you apply and pass down. Consistency, patience, and education are the real wealth multipliers. Even families starting with modest sums can implement sophisticated strategies typically associated with larger estates. For instance, creating a small family investment LLC with $50,000 allows you to gift membership interests annually to children or grandchildren. This achieves 2 powerful goals: gradually transferring ownership while teaching heirs how investments work through real participation. The most resilient family fortunes aren't built on passive inheritance. They're built on active participation and education. Create opportunities for younger generations to participate in investment decisions, even with small amounts. One family I know allows each child to direct the investment of their birthday money each year, with parents matching contributions to reward saving over spending. These early lessons in financial stewardship create the foundation for responsible wealth management later in life. Remember that building generational wealth is a marathon, not a sprint. The families who succeed take a multi-decade view, focusing on steady growth rather than get-rich-quick schemes. They prioritize financial education across generations, ensuring that each family member understands not just how to preserve wealth, but how to grow it responsibly. You can start building generational wealth with just $50,000 by focusing on growth investments, strategic gifts, and teaching your family to continue the process. The key isn't having massive amounts of money today. It's applying the right principles consistently over time and ensuring that future generations understand how to maintain and grow what you've started. Your 5-year countdown plan. What to do before 2026. The tax changes coming in 2026 aren't just a distant concern. They're a ticking clock that requires a systematic approach rather than last-minute scrambling. But here's the good news. You've still got time to protect your family's wealth if you start now. Let me give you the exact roadmap you need for the next 5 years. Those modest sums we just discussed, they have an incredible chance to grow right now, but there's a major plot twist coming in 2026. What separates families who build lasting wealth from those who miss the opportunity isn't just knowledge, it's timing. The estate tax exemption is about to be slashed by nearly 50%, and your 5-year countdown to protect everything you've built starts right now. Starting early gives you a massive advantage. When families rush wealth transfer planning in the final months before a tax change, they make costly mistakes. They miss opportunities, overlook important details, and often create more problems than they solve. A methodical approach spread over the next few years will help you capture the full advantage of current tax laws while giving you time to educate your family and adjust your strategy as needed. Let's break down exactly what you should be doing each year until the 2026 deadline. In 2024, you'll want to start by assessing your current financial situation. This is the year to get a clear picture of your assets, liabilities, and potential estate value. Schedule consultations with estate planning professionals who can help you understand how the coming tax changes might affect your specific situation. This is also the perfect time to begin implementing those basic annual gifting strategies we discussed. Start making those $19,000 gifts to reduce your taxable estate while the exemption levels are still high. The key this year is laying the groundwork and getting professional guidance tailored to your unique circumstances. By 2025, it's time to establish those simple trust structures that will form the foundation of your wealth transfer plan. This is the year to seriously consider setting up a spousal lifetime access trust if you're married. With just 1 year left before the exemption reduction, you'll want to accelerate your annual gifts and consider funding education accounts for children or grandchildren. Every dollar you move out of your estate this year potentially saves you 40 cents in taxes after 2026. Think of 2025 as your preparation year, getting all your structures in place so you're ready for the main event. 2026 is your critical year. This is when you'll need to complete any major wealth transfers before the exemption reduction takes effect. If you've been considering more complex structures like family limited partnerships or dynasty trusts, this is the year to finalize them. Remember, the deadline isn't December 31st, 2026. It's actually the day the law changes, which could be earlier. Don't wait until the last minute in this crucial year. Think of it like preparing for a major exam. Cramming the night before rarely produces the best results. But your planning doesn't stop when the exemption drops. In 2027 and 2028, you'll want to shift your focus toward family education and governance structures. These years are about ensuring that future generations are prepared to manage and preserve the wealth you've protected. This is when you'll establish family meetings and educational programs to build financial literacy and share your family's values around money. The most sophisticated legal structures in the world won't protect your wealth if future generations don't understand how to maintain it. Throughout this entire process, you'll need a team of professionals to guide you. At minimum, you should have 3 key experts in your corner: an estate attorney who specializes in wealth transfer strategies, a financial advisor who can help you structure investments appropriately, and an accountant who understands the tax implications of each move you make. Think of them as your wealth transfer dream team, each bringing specialized knowledge to protect your family's financial future. I've seen too many families struggle with procrastination when it comes to estate planning. Some of the most common roadblocks include the fear of having uncomfortable financial conversations with family members and feeling overwhelmed by the complexity of the planning process. The best way to overcome these barriers is to break the process into manageable steps and start those conversations early. Your professional advisors can help facilitate these discussions and simplify complex concepts. Another major procrastination point is the discomfort in confronting mortality. Estate planning forces us to acknowledge that we won't be here forever, and that emotional hurdle stops many people from taking action until it's too late. Remember that wealth transfer planning is actually an act of love, protecting the people and causes you care about most. The timeline for implementing these strategies is absolutely crucial. Many wealth transfer techniques require time to work properly. Trusts need to be funded, assets need to be appraised, and family members need to be educated. Waiting until the last minute creates pressure that can lead to rushed decisions and missed opportunities. Each year between now and 2026 offers unique planning advantages that compound when used together. What makes this systematic approach so powerful is how each year builds on the previous one. Your annual gifts in 2024 reduce your estate, while providing funds that family members can invest and grow. The trust structures you establish in 2025 create the vessels to receive larger transfers in 2026. And the family education you focus on in 2027 to 2028 ensures that all your careful planning isn't undone by future generations. The beauty of this 5-year plan is that it turns what could be an overwhelming task into a series of manageable steps. Instead of trying to implement every strategy at once, you can focus on the right actions at the right time. This approach also gives you flexibility to adjust your plan as your family situation changes or as new tax strategies emerge. Remember that implementing a structured timeline isn't just about beating the 2026 deadline. It's about doing wealth transfer planning the right way. Rushing creates mistakes, but a methodical approach over 5 years gives you time to understand each strategy thoroughly. Watch how assets perform in different structures and make adjustments as needed. The critical family conversation: how to talk about wealth transfer. Beyond all the strategies and timelines we've covered lies an uncomfortable truth. Even the most brilliant wealth transfer plan will fail without the one conversation most families avoid completely. Did you know that 70% of family wealth transfers collapse not because of bad tax planning, but because nobody talked about how to handle the money before it changed hands? Legal documents are essential, but they're just the beginning. Think about it. You could create the perfect trust structure, minimize every tax, and still watch your family legacy crumble if your heirs don't understand your intentions or aren't prepared for the responsibility that comes with wealth. Money conversations are awkward. There's no way around it. Most families find it easier to discuss almost anything else. Parents worry about creating entitlement or revealing too much about their finances. Children feel uncomfortable asking questions that might seem greedy or presumptuous. And nobody wants to directly address mortality. This communication gap creates the perfect storm for misunderstandings, resentment, and poor financial decisions after wealth transfers. So how do you break this pattern? Start by creating structured family meetings dedicated to financial matters. These shouldn't be impromptu conversations squeezed between holiday dinner and dessert. Schedule them in advance, perhaps quarterly or semi-annually, in a neutral setting without distractions. Consider bringing in a family wealth counselor or financial advisor to facilitate difficult discussions, especially early on. Who should participate? Generally, adult family members who will be affected by wealth transfer decisions should be included. For younger children or teens, you might include them in age-appropriate portions of the conversation. One approach is to gradually increase their involvement as they mature, starting with discussions about family values around money and philanthropy before diving into specific inheritance details. What should you actually talk about in these meetings? Start with your family's wealth. Philosophy, not just the numbers, but your values and vision. Share stories about how your family created its wealth and the principles that guided financial decisions. Discuss what you hope this wealth will enable for future generations, whether it's education, entrepreneurship, charitable giving, or financial security. From there, move into more practical territory. Explain the general structure of your estate plan without necessarily revealing exact dollar amounts. Clarify roles and responsibilities, who will serve as trustees, executors, or business successors. Discuss timeline expectations so heirs aren't caught off guard. And importantly, explain the reasoning behind any unequal distributions to prevent future conflicts. Getting these conversations started can be challenging, so consider these conversation starters that reduce tension. I'd like to share the story of how our family's wealth began, because understanding our history helps us plan for our future. We've been working on our estate plan, and we want to make sure you understand our thinking behind certain decisions. We'd like to start a regular family discussion about our shared resources and how we can use them to support each other's goals. These open-ended prompts invite dialogue rather than delivering pronouncements from on high. Of course, even the best-planned conversations will encounter challenges. Unequal distributions between children often create tension, especially when decisions are revealed after death rather than explained during life. Be transparent about your reasoning, whether it's based on need, contribution to the family business, or other factors. Consider whether equalizing inheritances might be possible through other means, like life insurance. Blended families present their own complications. Stepchildren, half-siblings, and multiple marriages can create competing interests and emotional responses. In these situations, clear documentation of your intentions is crucial, but so is creating opportunities for open dialogue between all family members. Business succession adds another layer of complexity. Who will take over leadership? How will ownership be divided? What happens to family members who work in the business versus those who don't? These questions deserve their own dedicated conversations with all stakeholders. When disagreements arise, and they will try implementing these governance strategies that successful multi-generational families use. One effective approach is establishing formal advisory committees or boards that include both family members and trusted outside advisors. These structures create a framework for making decisions objectively rather than purely emotionally. Family retreats can be particularly powerful for building consensus. These extended gatherings combine financial education with values clarification and strategic planning. In a relaxed setting away from daily pressures, family members can have deeper conversations about shared goals and potential conflicts. Another surprisingly effective strategy is involving younger generations in decision-making processes regarding family assets. This gives them valuable experience with financial matters while helping them understand the family's approach to wealth. Even modest responsibilities, like researching charitable donations or helping evaluate investment opportunities, build financial literacy and demonstrate trust. When navigating disagreements, focus on promoting transparency and creating a culture of open dialogue. Make it clear that questions are welcome and that understanding the reasoning behind decisions is encouraged. Document not just the legal terms of your wealth transfer plan, but also your intentions and values, perhaps through a statement of wealth transfer intent that articulates what you hope your wealth will accomplish. Remember that financial literacy education is crucial for successful wealth transition. If family members don't understand basic financial concepts, they won't be able to make good decisions about inherited assets. Consider tailoring financial conversations to different ages. Children can learn age-appropriate concepts that build knowledge over time. The greatest gift you can give your heirs isn't just financial assets. It's the knowledge and skills to manage those assets wisely. Families that engage in regular discussions about wealth transfer are dramatically better positioned to avoid the conflicts and misunderstandings that typically lead to wealth dissolution. Think of these conversations as the invisible foundation of your wealth transfer plan. Your trusts, partnerships, and tax strategies create the framework, but family communication provides the stability that allows that framework to endure for generations. We've gone through all the strategies, and now it's time for the hard truth. The 2026 tax changes are coming, ready or not. The real question is whether your family's wealth will be protected when they arrive. The average estate plan costs between $1,500 to $3,000, a fraction of the potential $2.8 million tax liability you might face without proper planning. Remember that every estate plan is different because every family is different. This isn't just about saving on taxes. It's about creating a framework that honors your unique family values and goals. Your wealth isn't just money. It's your legacy, your values, and the opportunities you create for generations to come. Don't wait until it's too late. Schedule a consultation with an estate planning attorney this week. You've worked incredibly hard to build your wealth. Now make